Hey guys, Michelle Massio here. Thanks for checking in. Thanks for checking out my video. As always, I'm going to do a quick video. I'm going to time myself. It's going to be less than 5 minutes, I think. And I'm just going to show you guys how easy it is to sell a put, what that means, and how you do it, and how much money you can make, right? So I'm going to share my screen. I just made this trade, but I'm going to show you because it's easy to understand and it's a really good example. Okay, we're going to look at Apple. So Apple stock, you guys all know they're a big powerhouse, right? So right now I'm just looking at one of the platforms that I use. Um, this is Interactive Brokers, but you could use anybody. Basically, don't get confused by all this stuff on the screen. We're going to start with a 52-week chart. Each tick, red and green bar up and down, is 1 day. So this is the past year, kind of where Apple's been. So you can kind of see that Apple sort of, has gone down the past few days. Let me zoom in a little bit more, right? I'm going to zoom into a month, right? So you'll see it got as high as 145.09 back on the 25th. That was just 4 days ago. And right now it's only 131.89, 84, et cetera. It kind of chops around. Okay, when you sell a put, what does that mean? So when you sell a put, selling options is so amazing because you could take in income as if you're an insurance company. And you could do it in a very, very smart way. And let me explain to you how this works. When you sell a put, it sounds confusing, but it's really not. It's you're taking an income and you're committing to buy a stock at a certain price. You pick the stock, you pick the price, and you pick the date at which the stock needs to fall before you purchase it, right? So we're using Apple as an example. Now, today is Friday, January 29th. Today is a good example because many options expire on Fridays. So this is really cool. So you could take control of your own destiny and create, the income that you want in order to live the lifestyle that you want. Trading is amazing because it gives you the ability to be able to do it from anywhere, right? I can, like, right now, I didn't take a shower yet. I just got finished working out. I made my breakfast. Doing a little bit of trading, and then I have a couple meetings later. So I don't need to, like, physically get up and get dressed and go trade my time for money. I could just I'm in my kitchen at my counter here, just kind of like putting some things in. So it gives you the ability to have this laptop lifestyle. You can do it from anywhere. You just need a Wi-Fi connection and a laptop, or maybe even a smartphone. I know somebody who trades on the smartphone. But let me get back to business, right? So Apple is 131.98. Okay, so we're going to look at a 130 put. What that means is if Apple falls from where it's at now, which is like 132, you'll see the price up here, 131.96, et cetera. If it falls $2 and it closes underneath 130 today, you might have to buy 100 shares at 130. Well, you might want to buy 100 shares at 130 anyway. It's trading at 132 now, which means if you did have to buy it at 130, you would be buying it at a discount. Lots of people like Apple stock. Why pay full retail price when you can choose how much you want to pay for the stock? Let me say that once more. Why pay full retail price when you can choose how much you want to pay for the stock? So you can do what's called sell a put, right? So here's where they're trading at. I know it looks confusing, but it's really, really not. We're just going to break it down into simple pieces. A 130 put right now is selling for $33. What that means is if you put an order in to sell a 130 put that expires today, $33 would get dropped into your account. You keep that 33 regardless of what happens. It doesn't matter if Apple trades higher or lower or in between or goes bankrupt. You keep the $33, right? One of two things will happen between now and the close of today. Now, right now, I'm in California, so it's 9:30 a.m., 10, 11, 12. It's 12:30 Eastern time. The market closes at 4. So we have 1, 2, 3.5 hours to go. So between now and the next 3.5 hours, if Apple drops, now Apple already dropped a lot today, right? So how much did Apple drop? It dropped over $5. If Apple drops another $2 in addition to the $5 it already dropped, if it drops another $2 and it closes at, let's say, 129.99, you are committing that you're going to buy Apple 100 shares at 130. That's what you're doing. you keep the $33 either way. If Apple, let's say it drops to 129 and then it goes back up again, you don't necessarily have to buy Apple stock. You keep the, oh, that was 5 minutes already. Holy cow, we're gonna go another 5 minutes. I'm gonna make it no more than 10 minutes because I wanna do quick videos so you guys understand the concept. If Apple doesn't drop, let's say it drops and then it bounces back up again. If it closes at 130.01, you keep the $33 and you don't buy the shares. Because this option is expiring today, after today is over, after 4 o'clock Eastern, let's say tomorrow or Monday, the trade is over. There's no more risk. That's it. You could put another trade on, but there's no more risk. Now, what is this? Right now it's trading at $36. So it goes up and down, right? Because that's how the market works. Now, some people might say, well, how much do I have to put up? So you have to put up what's called margin. Margin is like, let me go back to Apple. Margin is like good faith money. So it's kind of like you have to have some money in your account as like collateral in order to make the trade. So it depends on what kind of margin you have. I have what's called portfolio margin. So portfolio margin is like kind of like a gray calculation that the custodian calculates to say, Michelle, you have to have X dollars in your account to make this trade. And what they use is like all your positions, how much risk this is. Now on the risk side, let's talk about risk for a moment. This risk, the Apple going from where it is now, which is like 132.18, it's gone a little bit higher since we've been talking. For it to go to from where it is now, 132.19 to 130, there's only, see this delta. Delta is like the statistical likelihood that it's going to go from where it is to this strike price, 130, between now and the expiration, which is the close of today, 4 o'clock Eastern time. There's only 8% likelihood that's going to happen. So it's not an exact science, but that's the statistical likelihood. So the world is made up of statistics, people, right? So the statistical likelihood that it's going to go from here to here is 8%. I personally, the way my margin works based on my account, I have to put up $1,478 to make this trade. So my initial margin is $1,478. You also have maintenance margin. We're going to talk about that in another video, so ignore that for now. What this means is I just have to have $1,478 in order to make this trade. Now, I like to calculate a lot of things, right? What's my rate of return? If I'm putting up, ignore the top things, so just look at this line here, right? The highlighted line. Apple, if I am, I sold it earlier, like minutes before I started making this video, at $44. If I have to put up $1,478 and I'm taking in $44, assuming the option will expire worthless, because there's very only small chance that it will force me to purchase 100 shares. And if I do have to purchase 100 shares, I'm okay with that because I like Apple. And then I can sell a call against it. We're going to talk about that in another video. It's all good. It's not the end of the world. What is my annualized rate of return? Well, if I'm only putting up 1,400 and I'm making $44, in my case, I made $44. My annualized rate of return is a little bit over 1,000%. That's assuming that it expires worthless. Now, I'm not saying this video, oh my gosh, make this trade, you're gonna make 1,000%, this is a guarantee, blah, blah, blah. There's always gonna be risk, obviously, in the stock market. You have to be kind of like a dodo if you don't get that, like, right? So you can lose some money, you can perhaps lose all your money. So there is going to be risk, but the idea is to take educated statistical likelihood positions in the stock market. And if you trade like this over and over again, you will be successful. I'm telling you. So this is a way, I'm almost up on this is going to be a 10-minute video. I'm almost up, so I'm going to cut it short in a moment. This is a way this is great for people that, let's say you don't have any stocks or you've been wanting to buy Apple anyway, or something like that, and you want to kind of get in the stock market. Don't pay retail price, sell a put. Then, I mean, the worst case scenario, let's say if you want to buy Apple, let's talk about worst case scenario, because I think it's important to understand risk while we're talking about this trade. If you want to buy Apple anyway, don't pay retail price, sell a put. The worst case scenario, there's two things that could happen. Let's say, like right now, something happens and Apple goes down $10, right? And it goes down to 125 before the market closes. If we sold a 130 put, we're going to buy Apple at 130, right? So you have to make sure whatever strike price you're choosing, you're going to be okay with purchasing that stock at that particular price. You have to be okay with that because that can happen. If it goes down a lot, you're purchasing it at the price at which you already picked, right? So you're already kind of pre-committing to that. Number one. Oh, that's our 10 minutes. Number two, the other perhaps worst case scenario is if you really want to buy Apple and you sell a put and Apple skyrockets way up, you're not going to buy Apple because it didn't dip, forcing you to purchase the shares. You just keep the premium that you made, that $44 or whatever the case is, and you don't get in and you miss the upside. But what it does do, and pay attention to this, what selling puts does do is it allows you to create consistent income on a regular basis. You are becoming like an insurance company and you're saying, okay, Mr. Market Player, if your Apple stock crashes, I'm going to buy it from you at this price. For that commitment to buy your stock, if it crashes, you're going to pay me X dollars. I'm going to keep that money regardless of what happens with the price. Just like car insurance. I pay for car insurance. I pay the car insurance company, let's say $1,000 a year, and they are promising to fix my car if I smash it, right? If I don't smash my car, they don't fix it because there's nothing to fix, right? Because I'm not smashing it. They don't give me my money back. They keep the premium. This is the same. When I sell a put on Apple, and I'm just reiterating this, to sometimes these concepts are kind of, difficult to understand at the beginning until you learn. And then once it clicks, I'm telling you, it will click. When you sell a put, what you're doing is you're committing to buy a stock at a certain price if it drops to that price. If it doesn't go down, you don't buy it. Either way, you keep the money. So it is literally a way that you can create income for yourself each and every day. Why do I say each and every day? Because you can sell puts each and every single day. Lots of puts expire every Friday. I could do this trade on Apple Monday, Tuesday, Wednesday, Thursday, Friday, and I could do it for today. I could do it for next Friday. I could do it for the following Friday. It's very, very flexible. You choose the stock. You choose the price at which you'd be okay with purchasing it. And you choose the time frame during which you have that obligation to buy it if it drops to that price. It's this, once you learn the concepts, options trading is very much like driving standard shift car, right? So I got my license, my driver's license when I was 16. I drove an automatic, but then when I was like, I think I was like 22, I was entrepreneurial. I had a business. I was always kind of like, doing different things, and I wanted to drive a hot sports car, right? So what did I buy? I bought a BMW. What was it? Holy cow! It was like a two-seater convertible. I forget what the model even was. It was like in a James Bond movie. I don't even know if they still make them anymore. Anyway, it was like this little hot blue sports car, two-seater convertible BMW, and it was stick. And I was like, oh my God, I don't know how to drive standard. And then when I started learning, okay, I have to use my right hand, I have to use my left foot, my right foot, it's all these different pieces. It was so confusing to me. But guess what? Once you do it a little bit, it clicks. I haven't drove stick in a long time, but I'll tell you what, if I hopped in a car and drove how to drive standard, I would remember how to do that. Options is the same thing. It's a little bit confusing at the beginning. This might look like, oh my gosh, what the heck are you showing me, Michelle? Like this is all a bunch of shit on the page. But no, break it down simple, and it's easier, than what you think it might be. So if you like this video on how to sell a put and how easy it can be to take in income, please like this video. Please feel free to drop a comment in the section. Subscribe to my page. I'm trying to put up a lot of videos to piece things together to show people, okay, this is how you sell a put. This is how you sell a call. I have lots of different videos on different things. So please subscribe to my page. Also, I'm going to be doing, and I do this on a regular basis, courses. I'm going to do a 5-day live course coming up. I'm going to drop that in the comment section at some point when I figure out a little bit more on how to use YouTube more effectively. But it's going to be a 5-day course live, offering Q&A pieces, showing you exactly A to Z on how to do this, how you can do this, and how you can be successful. So thank you. I went way over on the time on this video. I hope this helps, and happy trading. Happy Friday to all of you.